Welcome to ByteCrypto Academy, where you master crypto one byte at a time. In this video, we'll compare investing and trading, step by step, without bias, so you can confidently choose the strategy that fits your goals. Before we compare them side by side, we need to clearly define each one. Let's start with long-term investing. Long-term investing, often called hodling in crypto, means buying an asset and holding it for months or even years. The goal isn't to profit from small price movements. Instead, investors focus on wealth accumulation. They believe the project will grow significantly over time. For example, someone who bought Bitcoin years ago and simply held through volatility practiced long-term investing. This strategy requires patience, emotional control, and strong conviction in the asset. But not everyone wants to wait years for returns. That's where trading comes in. Trading focuses on short-term price movements. Traders aim to profit from volatility, buying low and selling high within shorter time frames like minutes, days, or weeks. There are different styles of trading: day trading, swing trading, scalping. Unlike investors, traders rely heavily on technical analysis, market timing, and risk management to capture 5 or 10% move. It's more active and often more stressful. So now that we understand both approaches, let's compare them side by side. We'll compare them across 4 key factors: time, risk, psychology, and skill. Let's start with time commitment. Long-term investing doesn't require constant screen time. You research, invest, and allow time to do the heavy lifting. It requires less daily attention. Trading, however, demands attention. Charts must be monitored and decisions must be made quickly. But how much time you spend is only part of the equation. What truly changes the experience is risk. Trading can generate faster gains, but it also exposes you to faster losses. Short-term volatility becomes both the opportunity and the danger. Long-term investing reduces the pressure of daily fluctuations. However, it does not eliminate risk. Markets can still move against you for months or even years. And where there is risk, there is emotion. This is where the real psychological divide begins. Traders need to operate in fast environments. Decisions are frequent. Market swings are immediate. Fear and greed can appear within minutes. On the other hand, investors face a different test. They must hold through long downturns, uncertainty, and negative headlines, sometimes for years. Both strategies demand emotional control, but just in very different ways. Beyond emotion, there's one final factor that often determines success: skill requirements. Trading requires technical analysis, risk management, timing, and strict discipline. It is a performance skill, can be sharpened through practice. Investing requires deep research, conviction, and long-term vision. It is a strategic skill, built on understanding fundamentals. Both paths can work. Both carry risk. Both demand discipline. So the real question isn't which strategy is better. It's which strategy fits you. The right approach depends on your personality, time availability, and risk tolerance. If you have a full-time job and limited time, long-term investing may suit you better. If you enjoy charts, analysis, and active decision-making, trading might fit your style. Some people even combine both. They hold long-term investments while using a small portion of capital for trading. In crypto, success doesn't come from choosing the faster strategy. It comes from choosing the strategy you can consistently execute with discipline. Whether you invest long-term or trade short-term, risk management and emotional control are what truly matter. So, are you more of an investor or a trader? Comment below and let's discuss. Subscribe to ByteCrypto Academy, where we simplify crypto one byte at a time.